Now, everyone wants to know where I can get the best deals, what I should be investing in 2024 to get ahead. But the real important thing is to actually look at what you shouldn't invest in, because what you should invest in is where a lot of people make the mistakes. So I'm going to give you 3 tips in this video where I'm going to share with you what I personally wouldn't investing in if I was a investor, whether I'm a new investor or a seasoned investor getting into commercial property in 2024. Now, if this is relevant to you, please leave a comment below or simply click on the link and book in for a strategy call where myself, my team here at Unikorn Commercial Property can help you realize your dream of financial freedom sooner through commercial property and show you and blend it to your individual needs. On a different note, we've got heaps of live events coming up, so there below, make sure you do attend one of those if you're interested in getting into commercial property, or simply get a copy of my book, Cashed Up Commercial Property. Off we go. Now, 3 major mistakes. Now, the number 1 mistake that most people make is follow the trends. Now, what is the trends in 2023 and 2024 that is continuing is buying in Perth. Now, every buyer's agent out there is telling you, go and buy in Perth. Every buyer's agent out there is showing you the residential, how much Perth has grown. And I am just sick of seeing people getting the same yields in Perth as if they were getting in Brisbane and thinking they've got a good deal. I'm seeing posts on social media, on Facebook, and I'm seeing on Insta, and I'm seeing on YouTube people going, I got 6.3% yield on an industrial in Perth. Now let's dissect this. Perth is a mining town. It has 1/5 the population of a Melbourne or a Sydney. It's got probably 1/3 of the population of Brisbane. Its underlying economic factor is mining. Mining is the biggest driver of that town. It is the biggest employer, the biggest tenants, and it is the only industry that actually attracts the tenants from the eastern seaboard coming over and attracts overseas money. Now, when that fluctuates, yes, it's made lots of millionaires, but when it fluctuates, it affects their property prices. They don't correct, the property prices in Perth don't correct like any other state. They correct really hard going back 8 or 10 years, literally dropping to the same level as if you bought it 8 or 10 years ago. Now, that can be a disaster waiting to happen. But what I can't understand is, yes, if you're getting 1 or 2% higher than the market in the eastern seaboard, so in Sydney, Melbourne, or Brisbane, and Perth cannot be benchmarked against Sydney and Melbourne, and that is when people are pulling the wool over your eyes. And that's what I really hate about unscrupulous buyer's agents out there who are literally pulling the wool out of you, over your eyes and goes, wow, you get 6.3% in Perth. Look, at Sydney, you're getting 4% or 3.7%. You're doing 3% above Sydney. That's absolute crap. You need to get like 1% or 2% more than Brisbane in order for you to do the deal, because Perth needs to be benchmarked against Brisbane, and so many people get it wrong. So Perth gets benchmarked against Brisbane if you're not getting 1 or 2% more than the same class of assets, so warehouse to warehouse, office to office, retail to retail, then don't invest in Perth. It is a disaster waiting to happen, because the thing is, you're fluctuating with the market with just a 1 single driver economy. Perth versus Brisbane has multi-driver economy, and if you're getting 6% in industrial or even 5.7% versus 6.3%, I would still buy industrial in Brisbane. I will buy Brisbane office space for 6.5%. The thing is, if I don't get 8% in Perth, I won't go there because of the risk factor, because I know the back-end growth. The back-end growth with Brisbane is so much stronger versus Perth. So if you look at this, my thing for 2024 is do not invest in Perth, because we've had the rise, the bubble will burst in the next 12 months, and people will see it flatline. They will see they're not able to put rents up, they're not able to get the capital growth out, and that will all just puff away. And then you'll see that you should have invested in the eastern seaboard, probably Brisbane or even North Queensland. Or if you're really chasing that 6.5%, then go to Albury. Go to a place like Albury or Wagga. You will still be able to get that returns, right? Why? There's no need to take that risk. It seems safe, but it's not. It's still a large mining town, number 1. Number 2, the mistake that you cannot make in 2024 that is going to affect you and sideline you, in fact, it will always sideline you if you do this, is buying in the same regional town but slightly out of town and thinking that you got a better deal, you've got better chance of uplift, and mistakenly thinking that yes, you've got a 0.5% more there, that you're doing better than the current market. That is a fallacy. Why is it a fallacy? It's because let's take Bundaberg for example, or we could take Rocky, or we can take Townsville, or we can take Cairns. It doesn't really matter where. We can even take Albury Wodonga. It doesn't really matter. But we're looking at the large region regional towns. Now, you've got the town centre and you've got some suburbs that are the satellite suburbs. Great. Right? They demand a certain yield, and let's say that yield happens to be 7% in regional, which is pretty standard at the moment. Then you've got a property out of town, and we often see this. We've seen this in Mackay, where there's a little shopping complex out of town, right? It's about 2 k's away, and it's got a mix of tenancies, and you think it's a great buy if you got that for 7.5%, but I'm telling you, it's not a great buy. The reason for that is, while in our head, like in Sydney and Melbourne investors, we think that 2 k's is nothing, right? 2 k's is nothing, it's 3 minutes drive. What would it matter? Because in Sydney, Melbourne, you can drive 200 k's, right? 20 k's, 200 k's, and you'll still be in the center. It will still be thriving, different from regional. 2 k's can mean the difference of one tenant versus the other. A lot of tenants don't want to leave town because that's where people come, right? So these tenants you're going to get are subpar tenants. They're always going to be subpar tenants that are on gross leases, don't want to have on a net lease, that pay outgoings. The foot traffic is not going to be great. You're never going to attract your brand name tenant. Now, it's different if you're a Bunnings or a Woolies or a McDonald's 2k out of town. Now, that's different. People drive there because you're a destination, right? But if you're a small retailer, strip, or got some bits and pieces of mixed use with upstairs tenancies and downstairs, you're never going to get full capacity out of that. But the agents will talk to you about it, and this is the bit that really gets me, is that the agent will talk to you and say, hey, you know what? You're going to get the uplift, get the tenant, pay the outgoings, and voila, you've now got a property that's yielding 10%. You've just got to spend time tweaking it. In reality, that doesn't work. And the other thing is that property is not going to grow in value the same way the central property is. And you probably will be miffed by that, but that's just how the game is played, is that those properties are always going to be sidelined as not as the most favorable property, right? Then you have the properties in the center who will continue to deliver their yields. The value will go up, but these ones will be on the side. And that's how regional works, right? There's certain parts of regional that just does not grow versus other parts of regional that are outstanding in growth. So when you look at that, make sure that you're not looking at it with rose glasses on, right? And you're not looking at it thinking, oh, I have potential that I don't have. Really get an expert like us to help you assess it, look at the pitfalls and tell you how you should negotiate the deal. I'm not saying you can't buy the deal, but that is the pitfall most people make. They go and buy that deal for 7.5% while they can get a 7% yielding in town. That deal should probably be an 8.5% deal. But we can show you how you can negotiate and re-put that deal together, and if it really has true potential or is something that's going to only cause your headache, right? And that's one of the reasons to reach out to us, helentarrant.com or unikorn.com.au, booking for your strategy session or join one of our live events to really learn more so you don't get burned. Because when you buy a property like that, you could easily wipe 10% off the value of your property, or it could cost you 10% in the purchase price of your property in capital works in the next 12 months. So really make sure you watch out for that. So number 2. Number 3 is the big ba-bum, right? And a lot of people are going to be disappointed by this, because I'm going to tell you that I would not personally invest in prime location. So let's say it's just out of the CBD, it's prime industrial or prime location, industrial, with a tenant in there that's on a 3 to 5 year lease. That's what everybody wants in the market. Why am I telling you don't buy it? Because I'm telling you it's already hit the peak. It's hit the peak because it's had 3-year run. 2020 to 2023, we've seen a yield drop from about a 7-8% down to a 5%. In areas like Queensland, in areas like Melbourne, we've seen like a 6% yield drop to about a 4.5%. In Sydney, we have seen traditionally over a 10-year period, a yield of 8 to 9% drop to a 3% in industrial. But also what's happened is in the last 12 months, we've also had a bit of adjustment in industrial rents. It's gone up by 20 to 30%. So what you will now buy, if you're looking at those prime locations with the right tenant in there on a 3-year lease, what we consider so solid, is a property that is going to yield at market or higher. So meaning that you're going to pay more than the market. So you might get it for 5.5% while the market's trading at 5.7 because there's so much competition. It's got a solid tenant. Yes, it was built in the last 3 years, so it's not going to have any inherent issues, but you also pay top dollar for it. The rent's also at top dollar, so there's not much movement. So what you will find is that's going to make your portfolio stagnant. It's going to give you security, but it's going to do nothing for your portfolio. And 2 years, 3 years from now, you're going to find barely little movement in the market because there's a lot of new builds coming in for industrial because there's been the biggest trends ever. whatever. Plus, there is not enough of this yield compression, so not enough driving forces to bring up the value, because while there is demand, there's going to be supply now coming into the market. Plus, your rent is at the top of the market, so you can't move rents. So you're going to have this stagnant portfolio that is still doing what it's doing right now when you first bought it. Now, if you're just happy to hum along and cruise along, that is fine. But if you're a client of Unikorn, what you are looking for is a financial freedom plan. That means you're looking for wealth creation on speed. That means you're looking for wealth creation that you go from one property to the second property to the third property every 2-3 years, or every 12 to 18 months through uplift strategies. And warehouse, prime location, with a good solid tenant where you're buying in for around the 5% mark at whatever the price point in somewhere like Queensland, like Metro, Melbourne Metro, or Sydney Metro, isn't going to help your portfolio. So if you're starting out and you're going, I'm just chasing for security, this is what the whole market wants, this is what I want, don't do it. Because if you do it, you will go nowhere with your portfolio in the next 2 years. You will be stuck, and you don't want to be stuck. You want to keep moving. But if you want a plan to keep moving forward, you want a plan that you can really action, and a blueprint and a strategy, because without strategy, you don't know which one's best for you. You can't see the opportunities in the market. Clients of Unikorn implement strategy blueprints, so they are not controlled by the market, not controlled by the interest rates. They chart their own path, and I want you to do the same, and I want to help you to do the same. So all you have to do is click the link below, book a free, it's a free, obligation-free strategy session with one of our strategists. They're going to give you a preliminary look at what you have and how commercial property helps you to move forward in your financial freedom journey. Click the link below, book, and I'll see you in the next video. Bye for now.